yeah, is fixed. And all during that relevant range, the assumptions during relevant range, total fixed cost is fixed. Constant fixed cost per unit decreases. Total variable cost increases and variable cost per unit constant. Now, we used that. We helped the management. We told them about various things in a single product and multi-product BEP point and the level of sales at which they need a target profit and the level of contribution maximizations they should do in case they face the resource constraints. And even when the multi BEP or a composite BEP, and also there we said that this is the level you should, with the product mix, you should sell it so that you will get a desired income. So that is one level. Now we are moving ahead in what we known as mother concept for management accountants, and that is relevant costing. Relevant costing. For your CMA exam, the management accounting section C, decision analysis is the uh, mother section in the entire CMA program. And out of that, relevant costing is an awesome concept. Relevant costing is very, very practically it is used. So in relevant, what is that relevant costing? What is that it challenges? I said it will challenge the golden rule. Golden rule challenging means what? In relevant costing, not necessary that total fixed cost will be constant. Some at when the relevant range is when you are out of the relevant range, you need to spend extra fixed cost. So there is a concept of incremental fixed cost. That is called step fixed cost. There is a step fixed cost concept. There is a steps. There is a range. This is relevant range 1. Relevant range 2. When you are out of the capacity, you will move to another capacity. You will increase the capacity. Relevant range. What we said in golden rule, during this relevant range, there is a TFC1. This is a constant. This is constant. But in relevant costing, you need to take certain decisions now. You cannot get stuck with that relevant range concept. You have to exceed that. When you exceed that, when you want to increase the capacity, you need to spend additional amount in fixed cost. You need to take additional space for rent. You need to pay additional premium. You need to pay additional property taxes. You need to buy additional machinery, additional depreciation. Because you have the orders. So there is a TFC2 will go up. TFC2. Between TFC1, total fixed cost 1, and total fixed cost 2, there is a step here. That is called step fixed cost. Generally, it is called incremental. So the word incremental fixed cost is a relevant cost. So in relevant cost, it challenges that golden rule that not necessarily total fixed cost is constant. Some fixed cost will be relevant. Similarly, there are so many concepts. Similarly, total variable cost changes. Yeah, correct, during relevant range. But you need not spend some of the variable cost. You can avoid a certain variable cost. Not necessarily that everything you should spend it. So there is a avoidable cost concept in relevant costing. So before we go and define what is relevant costing, one thing is for sure, not necessarily all fixed costs are irrelevant. Some fixed costs are relevant. Example is incremental fixed cost. Again, not necessarily. Total variable cost will be relevant. All total variable cost will be relevant. Some will be irrelevant if you are not going to spend on it. So we'll get into that terminology. But what is that relevant costing? What is that? We are taking, as a management accountants, we are taking decision today. Decision today about something. And what are those decisions? I told you already, we will go to that later on. A special order, make versus buy, discontinuing product, or service, if it is a loss making, to further process ahead the joint product, etc., and pricing. These are all the decisions. Today, we are surrounded with so much data. We are going to take a decision about something. And what is that cost we need to consider? What is that cost that becomes relevant for us for taking decision now? So now, for taking decision now, for present decision, simple criteria. What are the relevant costs? English language relevant. What are the relevant costs? So now for the definition of a relevant cost. To be relevant, okay? To be relevant, the costs, relevant costs are relevant revenues, let's say, but popularly the word is cost. To be relevant, cost should meet two criteria. Cost criteria, two. One, they should be incurred in the future. They should be incurred in the future. If it is revenue, they should be made in the future. That just replace that. They should arrive in the future. They should be made in the future. Cash flows, they should come in the future. Whatever we did it in section E, investment decisions, the annual operating cash flows, discounted annual operating cash flows coming in the future is relevant. And for calculating it, we used revenue minus costs that is going to be made or incurred in the future. Whatever we did it in section E, they are all basically relevant cash flows from relevant revenue and relevant cost. Is that clear? Is that clear? I am giving you that back end example. Hello. Nishmita Falel. First thing. Clear. In investment dishes, Vijay Suvarna. Hello. Always chat with me in the chat box. Don't use emojis because sometimes I don't see it. Maybe you are telling yes, but yeah. The thing is, whatever we did it in section E, revenues that are going to be predicted in the future, that is relevant revenue. cost that is going to be incurred in the future, relevant cost project that is relevant. So now the first criteria, revenue, the cost should be incurred in the future. And then the second criteria, if given the alternatives, in investment decisions we saw alternatives. So given the alternatives, they should differ. So basically, differing from a given alternative. Scenario 1, scenario 2, difference. Cost. So we are only taking into consideration for the present decision, and that decision can be anything. Maybe you want to purchase a machinery, you want to replace a machinery, you want to price a special order, you want to calculate whether should I go for an in-house production or should I buy it from outside. As a management accountant, as a finance manager, you are besieged with a lot of data, and lot of your peer managers are with you. And of course, your country manager looks at you. Then you have to give them, using this management accounting tools. This is actually costing, mother costing concept, relevant costing. So in a given scenario with a lot of data, you should be able to identify what is the relevant cost for this decision which we are going to take now. So to be relevant, this criteria is a must. That means all other things which happened in the past, which committed before, they are irrelevant. Other than this, all costs are irrelevant. Other than this, all costs, you should not at all bother about it. All costs are irrelevant. Opposite of relevant is irrelevant. With one example, let's understand. Then we will go for our terminologies. Terminologies are very, very important here. Shall I delete this? Delete. Screenshot. Confirm. Okay. So now let's take present decision in front of you. Presently, there is one question in front of you. You need to recommend that to your business leaders. Present decision. You are in an operations meeting, your maintenance managers, they're all coming to you because you are the leading light. Your profession is like that. As a finance manager, first they will approach you, and then you should take all those information and make a summary and recommend to your country manager. That is the protocol. Maybe technically they will discuss with your country manager, but when it comes to commercials, they will come to you. So present decision, you are having a meeting with them. They are telling boss, one machine is an old machine, we need to replace. So present decision is whether to replace or not. and existing machine. Ah. So now they are talking and you are taking notes. They are talking, you are taking notes. Purchase manager is there, maintenance manager is there, production manager is there, engineering manager, what have you. So when they are talking in the meeting, you are taking notes in your laptop or in your diary. So they give you one quote. They say, this is the data. Data, you are surrounded with data. New machine cost. New machine cost, let's say they say 100,000. Okay. And they also say that we are buying this new machine from the guy who supplied to us the old machine 7 years ago. Now technology has changed. This machine, we can work on it, but it will not be efficient. That's why we are thinking about replacing. Technically, they are very, very thoughtful about it. And your purchase manager, they have all gone to purchase managers and they have talked to the fellow who has supplied 7 years ago the existing machine. And that fellow is ready to what we know as exchange value. Exchange value. In America, it's known as trade in value. Trade in value. Another data you are noting down, 5,000. 5,000. Then your accountant is with you. GL accountant. He or she will give you that general ledger fixed assets register, that particular existing machine. Existing machine data. Okay. It says that 7 years ago it was purchased. 7 years ago it was purchased at $50,000. Sorry, electricity. No problem. You can continue to hear me. It was purchased at 50,000. And we have provided depreciation so far. Accumulated depreciation. It's 38,000. Yeah. And they're also telling that right now, if we don't replace, the maintenance costs are going up. Maintenance costs. So maintenance costs are going up. So maintenance costs of the existing machine right now, it is, let's say, around $500 per month. So these are all the data you are receiving. Now, what is that now decision? Decision is, should we replace? Technically, they are telling, okay, commercially, using management accounting tools, relevant costing, you should recommend. So now what is relevant costing? What are the relevant costs here? And if we don't replace, there is some maintenance costs are also going up. What is relevant? What is irrelevant? Okay, so now you have to put it in two buckets. Relevant costs and irrelevant cost. Now you are besieged with all this data. So now how to go about it? It's a simple case, but we will do more problems. So what I said relevant cost now? Something which is going to be incurred in the future and the one which should differ from the alternatives. Correct? Correct? Yes. Hello, hello, hello. Clear, clear? All of you listening? All of you listening? Ready, ready, ready? Asta, Albina, Ramananda. Now as a manager, what is that? What is relevant now? Relevant cost is, yes, new machine cost, $100,000. Because the criteria is that if we agree for replacing, company is going to spend this in the future. Yes, yes. Tell me yes, no, yes, no, yes, no. Hello. Yes. Okay. Next. If we replace, eventually if we replace this 100,000 is going to be adjusted. The supplier is giving us back 5,000. So basically, minus trade in value is relevant. Trade in 5,000. So my net of outflow is 95,000. Cost that is going to be incurred in the future, this is relevant. Up to now, okay? Up to now, okay? Irrelevant cost for this decision. 7 years ago, I purchased for 50,000. The historical cost, 50,000. Related accumulated depreciation, 38,000. What can I do with that? It is already happened. Yes, yes, are you all listening? It has already happened in the past. Yeah? Clear, clear, clear? Already happened in the past. Now I should not worry about it. What is that I will do? So, carrying value, 12,000. So right now, this historical cost, this depreciation is totally irrelevant. And the name for that is beautiful name. These are known as sunk cost. Sunk cost. Already happened in the past. Okay, okay. Up to here, okay, up to here, okay. Okay. Clear, 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 up to here. We have not yet done. We have not yet done. Now, what is again relevant? My carrying value is 12,000. Supplier is paying me 5,000. Yeah, correct? Now what happened now? What happened now? Loss, right? Hello? Hello, hello, hello. Tell me yes, no, yes, no, so. Loss 7,000. Clear, clear, clear. Vijay. Albina. Loss. Loss 7,000. Loss 7,000. Now that is, we cannot take like that. If tax is 30%, tax benefit is relevant. Tax benefit on loss 7,000 into 30%, 2,100 it is relevant if I'm going to replace it. Clear, clear, clear? Clear? Gain or loss. Gain or loss. You remember that tax gain, loss tax benefit. That is relevant. Now another one. It's beautiful concept. We are not doing anything here. We are just classifying into two buckets. Next. Now, if I look at the data, something makes me another more concept. If we are not replacing, if we replace, okay, these are the relevant costs. If we don't replace it, this maintenance cost, maybe this is a 10 years life, 7 years finish. So if we don't replace, maintenance cost, 5,000 per month, 500 per month into 12, maybe in the rest of the life, 3 years. How much is that? 18,000. Correct? Correct. This is going to be incurred in the future. Yes. Clear.